The Tax Rep podcast is now proudly partnered with Nice Job, the experts in reputation marketing. Reviews are so important for attracting new clients. Before Nice Job, I would ask people to leave reviews, but they would usually forget, and I didn't have a way to stay on top and remember to follow up with them. That's where Nice Job comes in. Their smart follow-up campaign recognizes who hasn't left a review yet and automatically sends carefully timed reminders that can increase your chances of getting a review by 300%. I tried Nice Job for Tax Rep, and it's been a game changer. We added 33 five-star reviews in our first month, and our Google business profile is like a magnet for new customers. You can try Nice Job for free for 14 days and get 50% off your first 3 months by visiting nicejob.grsm.io/taxrep. nicejob.grsm.io/taxrep. I'm going to put a link in the description of the podcast. Try it. It will be a game changer for your business as well.
Hey, everyone. Thank you for joining us on this week's Tax Rep Network podcast. Today, we're talking actually about a really interesting topic. It didn't come up often, and it's coming up a lot more often. And it's an area that's really, as I've been discovering, has been changing a lot over the last 10 to 15 years. And it's something that any of you, especially that have corporate clients, S Corp or C Corp, it's a critical area. It's called reasonable compensation, and it is a hot button item for the government, for IRS auditors. And what we're going to do is tell you everything you need to know, maybe not everything, but a lot of what you need to know to help your clients and also protect yourself. So I am joined today by Paul Hamann. Paul from RC Reports. Paul, thank you very much for being here. I love the reports, by the way. You know, now that we've started using it, it's really a cool report.
Thanks for having me on, Eric. I really appreciate that.
I do want to get into the actual reports, but before that, let's talk about reasonable compensation. Because it can kind of go both ways. You can end up with, on the C Corps, taking too much, and normally in S Corps, what we usually see is not enough or none at all. And it's funny because what I remember when I had this come up, it was the early 2000s, where people took no reasonable comp. Everything from an S Corp was just distributions, right? Isn't this great? We're avoiding the self-employment tax. And the IRS came in, and based on those older cases, and we can get into that, if you didn't take a reasonable salary, it says, or if you took no salary, everything would be considered salary. Having now just gone through this recently, which is why I was so happy to have you on, that's really no longer the case. So if you don't mind, why don't you bring our audience up to speed on sort of where we are in terms of reasonable comp and what has shifted from those early 2000s to now?
Yeah, absolutely. I'm happy to talk a little bit about that, a little bit of history. So if you kind of anchor a date in your mind, anchor 2005. So prior to 2005, when you look at the court cases that came out, and I've looked at a lot of them, probably almost all of them, and it was that all or nothing scenario where the taxpayer would take everything out as a distribution, and the IRS would come in and reclassify everything as wages. So it was this all or nothing back and forth game. And the court cases prior to that, 2005 kind of anchor date, reflected that. And somewhere, and I'm doing this from memory, so it might not be spot on, but somewhere in the 2002, 2003 timeframe, TIGTA, Treasury Inspector General for Tax Administration, put out a report on reasonable comp and S Corps and compliance. And you had mentioned that S Corps were taking very little, if any. So this report pointed out that the average reasonable comp amount being paid in that study was $5,300, $5,300. Any guess as to what the distribution amount was on average?
100,000.
$349,000.
There's a slight, yeah, we're a little off there.
There might be a compliance problem, right?
Right.
So some of these early court cases, that TIGTA report led to the IRS launching a compliance study in 2005. That's really when the world of reasonable compensation changed dramatically, except it didn't happen in 2005. It didn't really start happening until 2010 when the court cases came out, the GAO report, other TIGTA reports, and just a whole parade of information that's been slowly dripping out from 2010 through even as recently as last year. And so that's where we received the fact sheet, 2008-25 fact sheet, court cases that changed things around a little bit, really pointed out how the IRS changed up its enforcement and compliance and some other things, as well as internal job aids that outline some of the methodologies and approaches we use now. So that's where we are today. But so many folks are anchored in, prior to 2010, this giant vacuum or void of information. And so a lot of myths and other kind of what we call rules of thumb or safe harbor ways of determining reasonable compensation became real popular. And they were so popular that a lot of advisors still today think of them as fact, but they're not. They don't live anywhere in the court cases or the IRS information. It was just simply a way of filling a void with zero information on the topic.
Right. Right. And so what I was saying is the more recent audits I've had, the auditors have come in and they're actually it appears they're trying to come up with a reasonable salary. All right. I had one, it was one of my tax rep members' cases. They had taken 20,000. They had netted 240,000 before the wages. And the auditor, I think, came up with like 84,000 from an internal study. All right. And I want to get into how RC Reports works because I do want to get into the reports because they're really helpful. Let's just put it that way. If you've never seen one, we will actually get you a link. You can go check out the report, and honestly, you'll be able to get a deal with RC Reports. But this is something that I think every corp I would be urging all of my clients to do. But anyway, the IRS did appear to be trying to come up with what was a reasonable salary. And in the consultation with my tax rep member, because that's what we do, we consult with all our members, we're their help desk. And she said, "Do you think this is worth challenging?" I said, "Do you think it's unreasonable?" She said, "Honestly, my clients admitted that's even probably a little low compared to what they would get if they walked to one of their competitors to be hired." I said, "Look, I mean, how much money do they want to spend fighting on something that they're probably not going to win? If in fact we're fairly convinced that's reasonable." But what my takeaway is, well, geez, I expected the government to come in because I don't deal with this that often. And all right, you didn't take a reasonable salary, 220,000 or whatever, 240, whatever it is. That's now all your payroll. I then had it happen again. Same thing. IRS was proposing a salary that didn't seem that in that case, it was a little higher than we thought. But again, there was clearly an attempt to come up with something reasonable versus those old cases of, hey, you're in for a penny, in for a pound. The whole thing is salary. So, which is what prompted my kind of diving into this, and finding RC Reports. So, let's talk about this. So I am a CPA or EA. I have 5, 10, 30, however many corporate clients. What do you do? We see a lot of people like, look, I pay all my people between 30 and 50,000. I'll take 51, right? Because I'm the boss. That doesn't really strike me as a good rationale for this. So first of all, there are two different approaches. There's a cost approach and a market approach. And the IRS, at least publicly, has always been more in favor of the market, at least from what I've read, the market approach. Can you describe what those are and what type of company would use one versus the other?
Yeah, so there are for compliance, there's a third one that we're not going to get into today because it's almost never used. But the cost and the market are the two predominant approaches when it comes to determining reasonable compensation. And historically, the market approach has been the favorite. And I believe that to be mostly because the approaches as they were developed came from the valuation side of the IRS and the valuation side of private industry. And those folks used industry-specific data, which is the market approach is also known as the industry-specific approach. And so I think just from a kind of a historic use case, the market approach has always been favored. But starting probably about 10, 12 years ago, another approach started to gain more favor, and it has gained quite a bit more acceptance, actually wide acceptance nowadays, called the cost approach. And so that is really geared toward the smaller business. And the cost approach is also known as the many hats approach. And that's where a small business owner wears multiple hats. And I think a lot of us can relate to that, right?
Oh, yeah.
And so the market approach doesn't really fit for us. And so when you kind of look at the definitions and the use cases, generally speaking, if you're a smaller business and you're wearing multiple hats for the company, you're going to look to doing a cost approach report. And it'll look at all the different hats you wear and the time you spent wearing the different hats, and along with the your level of skill proficiency. And then when you start to look at the market approach, these are generally for when we talk about closely held businesses or SMBs. This is when the business has grown up over time, typically. And now the business owner is either exclusively or predominantly in a position of either management or executive level. And that's when the market approach might fit better. Because the market approach will look at the owner and the business and the size of the business, the industry, to come up with that wage data, where the cost approach looks at all the different hats you're wearing and blends them together. And there's also a real practical reason why the market approach is typically used for kind of medium, also really large businesses, but most really large businesses are public or more publicly traded. And it's because industry-specific wage data is incredibly rare and difficult to find. It is just in numbers that are reliable, right? Collected in reliable enough data. But the few areas that are in those management and executive levels. So it's why you tend to see them used for, a general manager or chief executive, but you don't tend to see that used for a plumber, right? You tend to fall back on the cost approach.
Right. And now in RC Reports does have, like, from what I've been reading, like massive database of information in terms of wage and which is, I think, how you generate the reports that you do. And so to go back to the CPA or EA who has these clients, how do I get started? So I have this S Corp. The S Corp is before wages netting 150. How do I determine what reasonable salary is? So I go to RC Reports. Can you walk us through sort of what information do you need in order to generate what is a very cool report explaining not only what reasonable salary is, but how you arrived at it? Which, by the way, if you're listening, wondering why, that is what you want during that audit. If you can, how many people get audited and they kind of, how did you arrive at this salary? And it's, though you can't see me, but literally, like, touch your finger to your tongue and put it up in the air, like just whichever way the breeze is blowing. But if you can pull out a report and say, well, here's the report, even if the IRS doesn't agree with it, that's a hard thing to start punching holes in, right? Let's say their report comes up slightly different. It probably won't be off wildly, at least not from what I've seen. So what kind of information do you need? Like, in other words, Paul, look, I have my client, they own this S Corp, again, netting 150. What do you need from me to generate this report?
Yeah, so the data collection is pretty straightforward and simple, but circling back to something else you just mentioned real quick, we do have a saying here at RC Reports: the first with a fact-based figure wins. So when you do pull it out of your file, you've just switched positions, right? The IRS is now on defense, and you're on offense, versus what's the typical scenario that you just said, which is, how'd you come up with your number? I don't know.
Oh,
But here's the IRS number, and now you've got to battle
my
back.
accountant made it up. No, really.
Oh, getting thrown under the bus is pretty common.
Oh yeah, when people get audited, and the first thing I do is look at the whole business use of the home, and they're claiming 30%. I'm like, so how large? I always play dumb. How large is your home? 2,500 square feet. Okay, Bob. So your home office is 750 square feet? No, it's like 12 by 12. Well, that's not what your return says. And inevitably, it's like, I don't know where that came from. My accountant must have made that up. No, you made it up years ago and just forgot. I mean, let's be honest, right? But yeah, so yeah, how do you come up with that number? I don't know. We can do better than that. So what do I need to provide you?
Yeah, so we have a couple of different ways of getting the process started, but you or another CPA tax advisor, they'd log into our platform, and we'll give you a couple of different ways to gather that information from your client. And it's really preference, but my preference is you just put in a little bit of information about your client, click a button, it sends your client an interview link. The business owner clicks on the link, and we just walk them through a simple 7-step process that helps them think of, remember, and include all the different hats that they're wearing for their company. Then they portion out that time. We talk a little bit more about what their experience or skill level is, and it's done. At the end of that interview, we'll let Eric know, hey, your client Bob has finished the interview process. Why don't you pop in and take a look at that report? And you can go in there, look at it, and then you can consult with your client about it and make any needed changes. And so that process for your client, 15 to 20 minutes. The process of shooting the email out to your client, unless you're a slow typer like me, it's under 5 minutes. So, and then this is what advisors do best, right? They look at that report and they talk to their client about it and what it means and how it applies to their business.
Yeah, and you haven't, unless you've been listening in, I've been sort of on, certainly our tax rep members, but even all of our listeners, about getting their arms around their 1040 practice. And this may ring a bell for those of you listening. You want to work with people that you want to work with, all right? If you have clients that don't want to do a year-end review and consult with you, basically, if they just want to come and dump their documents on you in March and have you get this done, one is they're really cheating themselves, because the real benefit of working with a tax advisor is for advice. So if someone is self-employed, they should be meeting with their CPA or EA. I would suggest June and November. Otherwise, how can you help me if I don't know? This is one of those areas that if you have an S Corp or a C Corp, and I say this because it's in their own best interest, I would suggest they need to do this. I would make my clients do it. But you can also, I mean, listen, you can either just pass along the cost, which is not very much, or frankly, this should be another revenue generator. Okay. And frankly, you could even suggest an audit where, look, we have software. I work in this, all my S Corps. The IRS is picking up the pace now and going after folks on this. Let me know if you want to do it. I mean, I think the program, Paul, correct me if I'm wrong, like 700, 750 a year is the basic one. If you went out to your said, look, it's $250. This is how we audit proof this. And let me tell you the downside if we don't, right? But more than that, for the accountants themselves, I'd like to tell you my horror story. And Paul, you know this because I wrote this in a blog, and it got a big response. Actually, I got a lot of emails.
It did. It was one of our most trafficked blogs this year.
But it's sadly it's true. And by the way, I got so many people emailing me, asking me for the name. And I said, look, I can't share the name, but if you go and you search for it, it was in federal district court. You'll find it, right? I mean, it's you may not see the end result because it was settled. There's no decision, but you'll read the facts. The facts are basically he's now retired, but I had a friend, the CPA I was friendly with, who had I don't know 30 S corps. And he's on them. You need to take a reasonable salary. Every year he has these emails. You need to take a reasonable salary. You need to take a reasonable salary. The clients were, he doesn't do their bookkeeping. He does not do their payroll, which I think is critical. So in March, he's just getting dumped. The 941s, the 940s, from the payroll company. These people either aren't taking any salary or taking a joke salary. Made 150,000, they're claiming $5,000, right? In their base salary, in their wages. IRS comes in, audits one, now decides, forgetting about the taxpayers, let's look at the preparer. And now they start pulling every corporate, and that's when he called me and I said, you've got a problem. He said, I don't think so. I've got emails to I'm good. Provides the email and say, look, I've been trying to get them to, I don't do their bookkeeping. I don't do their payroll. They choose to do this. And what the IRS did, they hit him under 6694A and B, which is negligence, but also reckless disregard. And what they said is the fact that he was emailing year after year proves reckless disregard, that he knew it was wrong and did the return anyway. Now, if you're listening thinking, whoa, you're with me. We were like, are you deranged? No. Reckless disregard, that we did it anyway. The returns were accurate. This is what they did. The return is accurate. What the code actually says is that if the commissioner disagrees, meaning the IRS, if they disagree with what the salary was, they can adjust it. And our argument was, think about what you're asking the CPA to do. After the fact, either refuse to do the return or tell the client to adjust their salary. The W-2 is now wrong. The W-3 is now wrong. The 941s and the 940 are now wrong. We're going to get penalized across the board on all of that, right? That was not the taxpayers, in this case, the CPA's job. Now, in the end, ultimately, it was settled, but he was looking at a $130,000 assessment. What happens is you pay 15% down, and then you file for the refund. They're going to counterclaim, and you go into federal district court. It's settled for the 15%. So if you can do the math, right? Do the math, it's close to $20,000. Plus, we like him, we discounted, we aren't cheap either. So he's got his legal fees. I've not seen them do that since, but do be aware that if you have clients doing this year after year, and you are doing the return year after year, it concerns me that there's this opening for an argument, and they'd much rather go after the preparer than one taxpayer. Right? Because to the IRS, the bad preparer is the bane of all tax existence, right? They've got these, we got to stop the bad actors. The worst bad actors aren't signing returns. That's a whole different issue. The fly-by-night folks. But just be aware if you're listening to this, which is why if it were me, if I had a tax preparation part of my business, you would not get a corporate return without a report. Period, end of story. For the few $100s, just get it done. From a business perspective, I have a whole new revenue stream. And the other thing is, I'd actually go marketing to other corporations saying, have you done this review? This is critical. Come in, we can do this. And I would start consulting on that. But so if you're listening, here's my takeaways. All right. And actually, and Paul, we should talk about where the cases are now, because like you said, prior to 2005 and then since, But that's why this is so critical. I would require them to have a report to back up the salary. Unless you have an S corp where they're going to take 100%, in which case they don't have to. In fact, they're kind of overpaying. But if that's what they want to do, then fine, knock yourself out. But this is also a CYA for you.
Yeah, absolutely.
Yeah, but so bring us up to speed. So since '05, like I said, I've observed that they're trying to be more reasonable. What are the cases saying?
Yeah, so after 2005, a case came out called Watson, and that was really where the IRS got into the business of what we call, in their lingo, reasonable reimbursement for services performed. In other words, they're trying to figure out what that replacement cost is for the business owner, right? If they were to go out and hire a third party to do the same things they're doing. And then we see that in another case right after that called McAlry, and in other information that the IRS is putting out, their internal job aid and that type of thing. So it really did kind of change up how the IRS was looking at it. And now practitioners are starting to catch up with that. And preparer penalties are no joke. And so we started to see preparer penalties and hear about them. And I think the 2014, 2015 timeframe. And preparers are not real forthcoming. They don't want to talk about this, right? This is a really negative process they go through. There's other things that can happen to them in their practice. They can lose some certifications, other things, depending on how it all plays out. So we didn't hear about them all that often. And we were wondering if they were still going on because it was, part of some IRS training that happened and some other things. And then we heard about the case that you were just talking about, and they are still going on. And it's incredibly unfortunate, but when you have that client come to you and they're paying themselves $5,000 or $20,000 or nothing, and they have a large distribution, and or should have known that they're putting a lot of time and effort into the business, and that's just not a reasonable amount. The examiners have assessed preparer penalties. And so when you were saying that if you were running a practice, that you would make that a requirement, we're starting to see that as the new normal for practices. They're like, look, you can do this, but if you don't, we're not going to sign your return because it's $5,000 on us. And so we're just not going to do it. And, running that through a practice, as you said, making it an additional revenue stream. Some folks just add it to their 1120S package. No problem. Add a couple $100 on there. And it's just part of that year end. Other folks will charge per report. You'd mentioned a couple $100. We poll our subscribers. That's pretty low. Most of them are in the $400 to $500 range. But where I love it is with reasonable compensation is when you do consult on it and you bring it into your entity planning. What a perfect time to talk to your client about it. First off, you can help them recognize whether they should even become an S corp, because so many business owners have heard it through the grapevine or Googled it, right? If you become an S corp, you're absolutely going to save on payroll taxes. Not necessarily the case. You need to know what that reasonable comp number is, right, and consult with your client on it and show them how either they might not, that's going to save them going through that process, or how they could. So that's my favorite place to talk about it. But when it comes to keeping your clients safe, you had mentioned when they come to you in January, February, or March, not great. A friend of mine who's a CPA puts it this way. He says, if I can get my clients to come talk to me by December 31st, I have a huge toolbox that I can help them with. And on January 1st, I have a screwdriver. And it's not even a Phillips.
Right.
So.
No, I mean, all the planning that can be done. I mean, after December 31st, it's really a postmortem.
It is.
I mean, there's a little bit, maybe you could get them to set up an IRA, but it's that little, that's like the piddly stuff. I mean, the real planning that you can do for your clients is when they can make moves, right? When they can do things. And so honestly, I would be urging my clients, to do a mid-year. I'm picking June, but anytime during the summer, where are you? And then here are some ideas. Here are some things you can do. And that cuts both ways. One is the tax planning, but the other is if they're not doing well, sometimes you need a fresh set of eyes to come and say, look, we let's cut this out, let's cut this out, because we all get caught up in the day-to-day. It's good to have somebody come in who is not emotionally involved to say, look, let's step back here. This is not working. This is not, let's restructure. It's really to me, that's the benefit of having a CPA or EA. To just have someone do your return, you're really missing out. And I think the biggest problem, taxpayers don't put value on it, so they don't want to spend money on it. This is what, and I'm not kidding. We had a client come in, they're, as a couple, are making millions. They attempted to do their returns themselves with the TurboTax or whatever home software. Why? like why? And they're like, well, this didn't seem that complicated, except that now everything is screwed up. They now have liens filed against them, which is ridiculous. We have CPAs now who are going to now have to start redoing these things, and we're going to try to get them reopened. I mean, it has now become an expensive nightmare when it really didn't need to be. Just penny wise, pound foolish. This is one of those examples. You've no idea the nightmare this was for that CPA when they went after them. Can you imagine going home and telling your spouse, we have a proposed assessment against me because my clients didn't listen to me for $130,000?
That is not a conversation I ever want to have.
No, my wife, I don't think she would divorce me, but I mean, going into orbit would be putting it mildly. I mean, I have to tell you, Jeff and I were offended for him.
Absolutely. It's incredibly unfair, but it doesn't change reality.
No, I mean, so of course we're like, we have to fight, but listen, and we can discount our rate, but this is not going to be inexpensive. And so, no, I think that this, whether you look at it as business opportunity, whether you look at it as just simply covering your own rear end, so you don't have the horror story the CPA I know had, or just, doing the right thing by your client so they can sleep better at night. This checks every one of those boxes, and it's not that expensive. And I hate to use the term no-brainer, but I would urge anyone listening to this to seriously consider the idea. It's a no-brainer, right? If the client doesn't want to do it, then you have clients, I don't want to spend that. I don't want to spend that. I mean, what you could do is try to have them sign a waiver saying, we've advised you, you have decided not to do this. We will prepare the return, but we will not only not be responsible if the IRS adjusts it, but in the event the IRS were to attempt to assess penalties for us, you indemnify us. That'll get their attention.
Yeah, and from my seat, since I don't know kind of the legal maneuvers or legal processes that would be open, I was always curious if that would be similar to sending out a letter saying, you need to do this, you need to do this, you need to do this. It kind of demonstrates to them again that you knew.
And it backfired, which, by the way, for the record, the IRS auditor and the supervisor that did that, I think were off the rails. And I think that's why DOJ fairly quickly settled. And it still cost him money. But I really think at some level, they understood that this was a stretch. I mean, it was an overreach in my perspective. You're trying to get them to do the right thing. That proves, therefore, that you were doing the wrong thing, which, by the way, isn't even your job to do. It's the secretary's job if they don't think it's a reasonable salary. Which because it raises the issue. Paul, am I better off not saying anything and just going along? After that case, I would have said, well, maybe. Now, of course, that case was probably about 10 or 11 years ago. I think the winds have shifted a bit on this. I don't think we'd see that again, but I can't guarantee it. Net, go check out RC Reports. And by the way, let's bring it back to that, Paul, before we run out of time. I've got sample reports. I'm going to see if are these dummy ones that I can use that you sent me?
I believe, yeah, they are definitely, yeah, they're based on a
I would
fictitious
assume you didn't
client.
send me an
So
actual one, with an actual taxpayer. I mean, I'm gonna I'll put those up so people can check them out.
sure.
I think that people should go look at, but can you describe what is in the report? You know, so we're talking about this report that'll help support the number on the return. Describe what's in the report.
Yeah, so we built the reports to meet IRS criteria guidelines. So we use the IRS's guidelines and criteria. We used the court cases that we've touched on just a little bit today. But the reports are typically 5 or 6 pages. And the front page has nice big graphs on it and will pinpoint what the reasonable compensation figure is. And that's really for your client, right? That's the wow factor you want for your client. But as soon as you flip the page, that's where the examiners and the litigators are going to go to, because that's how the sausage was made. That's exactly how we got to that figure. In minute detail, we don't want to hide anything. We want to show you how we got there. We are the opposite of a finger in the wind, right? Exactly how we got there. And then after that, we have a short white paper on the methodology that was used, the backup for the data sources, court cases, other information that anybody that wanted to know that this was a credible report might be looking for, or for additional information. And so in our history, and it's our 10-year anniversary this year, our reports that have been used proactively have sailed through every audit they've been presented in. In other words, what you said earlier, pull it out of the file, hand it across the desk. Examiners check it off their list and moved on, because there's so many easier targets. And
Right.
you've done what they've said. You're not trying to pull one over on them.
Right.
Reactively, we're the voice of reason, right? If both sides are way off, if the examiner's way over here and the taxpayer is way over here, our reports are very good at getting people to come to some kind of an agreement or settlement that they can both live with. Kind of that independent voice.
No, and it's so common for people that don't do a lot of audit work. Oftentimes, just getting through the audit is having attempted to do what you need to do, because the auditors move on. There's easier stuff. I've never had a client produce a mileage log and backup, oil changes and stuff that support their numbers, and had an auditor go through and say, I don't agree with that. They look at that and they're like, okay. And because what they're thinking,
Yep.
Nothing to see here, time to move on. I believe the reason I have not pulled out an RC report and handed it over yet, but I can see where they'd be like, okay, this is what you took. You have an actual study that backs that up. Is this where I want to spend my time fighting? And by the way, let's say I can get it adjusted. How much? 10%? What's the tax on that? In other words, you take the wind out of their sails, move on. Same thing.
Spot on.
The fastest way, I'm hype on this, and for our members who go through the in-house, inside TRN training on this, what I talk about is the way to get through an audit is when that auditor shows up, you have everything laid out. Here's the return. Here's all the backup on it. Bathrooms over there. Knock yourself out. And you can watch psychologically. They're going to do their job. They'll tick and tie. Their heart's not going to be in it, because they're not going to find stuff. But if they show up and you're like, well, we're missing a bunch of stuff and we're trying to get this. Now it's a candy store, right? Now, well, you got to go through. You'll tell you, oh, we have to check everything now, because what they're seeing is, ooh, I'm going to adjust this and this and this and this. So I think that tying up those loose ends, having that. So if you're concerned with, how accurate would the report? I get news for you. It's better than not having it. And first of all, it's very accurate. But even if it weren't exactly accurate, 99.9, it's still going to resolve the issue, because you have it versus the person that doesn't.
Yep. The first with the fact-based number wins is
Right.
is kind of how that lays out, and it's held true in every scenario that I'm aware of.
Right. So listen, Paul, thank you for doing this. And just for everyone, I'm talking to Paul. We will probably do a webinar on this before tax season, late December. I'm thinking more early January, on reasonable comp, what you should be doing in your practice, how to approach this. I will put a link below so you can go check out the report and the deal. And this is the kind of thing I would bring to my corporate clients now, before end of year, because actually you can adjust comp now and push it through the fourth quarter before that final 941 and that 940 and W2, W3 is filed. The time to do it is now. Next year already, unless you're going to start amending and getting, and all that, time to do it is now. So go check this out. That's why I wanted to do this, this time of year, because we still have time to do something. We will do a webinar on this. It's a great topic, and it's an area that most people blow past, and it can be, as my client found out, big dollars, and potential liability for the accountant, which is ridiculous, but I have a client that lived it. So anyway, Paul, again, thank you for taking the time. Everyone go click the link, check that out. Look for an announcement from us on that webinar. And everyone, listen, have a great holiday weekend. I know Black Friday and Cyber Monday and Thanksgiving and football. But thanks for listening in. Go check that out. Paul, listen, thank you very much for taking the time.
Absolutely, Eric. Thanks for having me on. I really enjoyed it.
All right, everyone, and we'll see you next week on the Tax Rep Network podcast.